Hello, it's Paul. This is another practice video. I'm doing it now on, instead of this tab, I'm doing it on this window so that I can switch around to different tabs. So I'm researching Ondo Insurtech. You can see from here, no PE, no forecast dividend yield, and a negative balance sheet. So it's a jam tomorrow growth company, forecast 107 tab. You can see here, heavily loss-making. Minus 4.7 million PBT for March 26, despite a more than doubling of revenue, and then only gets close to break even on 14 million revenue in March 27. So this thing's got to achieve stellar growth to get anywhere near profitability, and then they've got it breaking through to profitability in March 2028. So, I mean, usually hockey stick forecasts like this are high in the sky, usually, but we'll let history be the judge of that. Historically, yeah, very small revenue, but a sharp increase in March 25, but it's still a hefty loss, a worsening loss of 6.2 million. The problem is it has to expense the cost of its little devices, its leak detection devices, which it claims have strong IP. It has to expense those immediately to the P&L, which makes me wonder why it doesn't capitalize them, but I don't know. So what does it do? Well, that was explained. Let me switch tabs. Now, why isn't the camera picking up on this? Oh, for pity's sake. Right, it is now after I clicked on another tab, so that's now recording, I think. So here we are. This is the Investor Meet company who kindly sponsor my podcast, but that's not why I'm doing this. This is the video from management, which you can watch. Scroll on to about 10 minutes in. That's the FD. That's the CEO, Craig Foster. It's a good briefing this. They really go through the products and the numbers. So yeah, that was really interesting. I watched that last night and took copious notes. The Investor Meet company webinar, and they answered a lot of questions towards the end as well. My honest impression, I found the CEO very, very good, very obviously really switched on, intelligent, passionate about the business. So yeah, broadly speaking, definitely got a tick in the box for me. Towards the end, slightly too promotional, I think. Yeah, just I can see why people are getting excited about this share, because I think the CEO is definitely, pushing it heavily and pressing about how exciting the opportunities are. So it's slightly too promotional, I think, for my personal taste. Anyway, what else have we got? Let's click to another tab. Right, I think I have to double click on the tab to get Loom to come across to it. Okay, here we've got, this is on their website, the full year results presentation again. That was it. That was Craig, who was on the presentation with his FD, Kevin Withington. Mark Wood couldn't come on the IMC because he had been called away by something. Yeah, so you can just scroll through these slides. It's a claim prevention Leakbot. It's a device that 5-minute self-install. Now, one thing I'm not sure about that is that's what they say, but then the financial model shows them having installation costs. So I don't quite understand that. Surely if you just post it out to the customer and they install it themselves, then somewhere else in a presentation, it shows a Leakbot branded van at someone's house, and they say they employ some plumbers to actually go and fix the leaks. But then they say they've only got 54 staff globally altogether, including the plumbers. So integrated plumbing service. Well, I mean, in America, for example, what have they got? Maybe 5 or 10 plumbers. We're going to have to travel huge distances to attend clients to fix leaks. So I don't see how that could possibly be an economic business model. Or maybe I've misunderstood it. Surely you just outsource and call in a third-party plumber to fix the leak. I don't really get that. So I'll have to ask. Here we are. You've got this Leakbot branded van with British number plates, which seems to suggest company staff are actually going to clients' homes, because that looks like a house, doesn't it? With a nice brick-built garage there. And this is the idea that they save clients money. £14 million estimated claims saved. 5.9 million revenue, contracted revenue. I think that's ARR rather than actual revenue. So it's quite early stage, and really the only market that matters is the US. They've pretty much said that. So I don't think there's any benefit to them being this small and being in 4 countries. I'd rather see them just, shut down the Nordics and the UK and saying we're focused, because the economics of it don't make sense, which they admit. In the UK, I mean, they said the average household pays £300 for their household insurance. I mean, I paid 95 quid for mine, so there's no way it would be economically viable for me to pay 60 quid or 50 quid or whatever for a Leakbot, But in the US, what they're saying is that the average house pays $1,300, and so the insurer, it makes a lot more sense for the insurer to pay $60 for a Leakbot annually if it's going to save a $14,000 water damage claim. So I think that stacks up. But from what I can tell, they maybe only have pilot contracts. I'm not convinced they're actual contracts. And I think the going concern note said something about that. So I need to have a look at the going concern note. So let's do that now. Why have I suddenly got bigger? Let's take that down. Right, that was just the sizing of Chrome. Okay, so this is the March results. So let's now do search for going concern. Here we are. Quite a long-winded one. Principal assumptions include continued activity with existing insurance partners and new activity with pipeline partners. I'll just pause this and I'll read it. Right, I've now read the going concern statement, and the key bit here, I think, says the board acknowledges under certain adverse scenarios that a material uncertainty would exist and additional funding would be required within the going concern period, which is 1 year from publication of the results. So I think we've got to work on the basis that whilst they really don't want to and probably feel they don't have to raise fresh equity, there is a chance that they might have to, and that's why you've got a material uncertainty on the going concern statements. Always worth reading these, they're very important. So I don't think we can just blithely assume that it's fully funded and it definitely won't need to raise fresh equity. They're saying here it might need to raise fresh equity, so take that on board, I think. Right, I'm pressing pause and then switching my tab and then pressing unpause. That's the first time I did that, so hopefully that would work better. So the revenue growth is the most interesting bit, and it is the recurring revenue is really quite good now. Well, it's on a very good growth trajectory. As I say, as management stressed, it's all about America, but they're not making any gross margin. You can see here for 2025, there's no margin because they expense all the product costs up front. So that's probably the only thing I don't like about this business model. But they're saying the cash position means they now get the cash up front from the customers. So I've got to look into that in a bit more detail. So I think the double entry for that would be debit cash on the balance sheet and then credit deferred income. And the deferred income would then just gradually be released to the P&L over however many years, 5 years maybe. But if that's right, then that should mean that the cash, although the P&L is demonstrating a loss, the cash position should not be a cash outflow, I think. I think that's what they're claiming. And certainly you can see in the March 25 balance sheet tab here, you can see that trade and other payables, which would include deferred income, has really shot up from 2.8 million to 4.6 million. And the cash pile has gone up. I think there was an equity raise during March 25. Let's have a look. Right, so I use pause again there to change tab, so I'll watch that back and see if it worked. Let's have a look at the cash flow statement. Here we are. So many investors neglect these, but they're actually more important than the P&L. So they start with the loss before income tax. I'm just going to focus on March 25 and ignore the prior year comparative. So a thumping great £6.2 million. It's pound, not dollars, isn't it? Yeah, pounds. 6.2 million loss before income tax. That is the starting point of the cash flow statement. Then they add back non-cash items. So they're adding back the share-based payments, which are modest. I can live with that. Depreciation and amortization is a non-cash item. Finance income and finance expense. Note that that figure is actually quite high. Change in working capitals, in working capital items there on inventories and receivables are negligible, but quite substantial on payables. That, as again, note 8, I think that'll be deferred income. So the cash used in operation is about half of the P&L loss, 6.2 million at the starting point, 3.2 million cash outflow. But of course, that's before finance costs. That's operational cash outflow, 3.2 million, slightly worse than the prior year. Purchase of intangible assets. Okay, they're capitalizing about £500,000 of probably IT development spend. Interest received only 70 grand, but at least that shows they are earning a bit of interest on some cash balances. CapEx on physical CapEx is negligible, so this is an asset-light business, probably just got an office with a few desks and computers in it. So again, we can work out what type of business it is from these numbers. So not much in the way of investing expenditure. Now you've got financing activities here. Interest paid, negligible. Repayment of borrowings. Okay, so it's reducing. Yes, here we are. This is the big line here. I'm circling a £7.8 million equity raise. And there was, 4 million of that remaining at because that was money raised during the whole year. There's about 4 million of it left at the year end. So it is a cash burner. That's why I think it might need to do another fundraise. But at 37 million market cap, it's not the end of the world, is it? If they say we need to raise another 5 million, it'd be about 15% dilution. And if they can prelude that with some contract win updates and get the share price up, it would be less dilution than that. So it's not a deal breaker having to raise a bit of extra cash. So you can see here the growth in the USA. That's what this share is all about. Highlighting all of it. USA, look, from nothing to just over 1 million. So it's basically a startup in the US that they're telling us is really gaining traction. Most of the costs here are staff costs, as you would expect for this type of business. Directors' remuneration, 641. Wow. That seems an awful lot for what's basically a startup. What happened to the concept of sweat equity? Why do directors of startups now think they can take out thumping great salaries before they've actually developed it into a viable business? That sticks in my craw. Professional fees seems very high. Not sure why that would be. IT systems and platform. Okay, yeah, fair enough. It's a cloud-based product and software. That sounds reasonable. They're probably using outsourced IT, I would imagine. No problem with that. Not many staff here. Just 5 directors taking out 600k. I mean, okay, 120k each, but some of them will be non-execs. So it means the main directors are probably taking 200-300 grand. That's an awful lot for a startup. I'd rather see them earning sweat equity rather than taking all that cash out personally. But this is the way of the world these days, I'm afraid. My ideas are rather old-fashioned. That's interesting. Interest payable on the loan notes. So those loan notes seem to attract pretty hefty interest. So again, it would be nice to get those paid off with equity at some point. I think they're 2027 repayable. I'm not sure. As I say, about 20% of them, I think, have already been paid off using money from the warrants. But that, of course, further dilutes shareholders. Inventories, not much in the way of finished goods. Payables, yes, that's found it. Deferred revenue, that's what I thought. So this 2.7, that is the credit entry for the cash that's been received upfront from the insurance clients. So, which is both good and bad. But that's what I thought would be the case. So I can see how the numbers fit together now. So that's all good. There's the vendor loan note. They revised the terms of the loan note to extend it. Well, but 12%, you see. It's quite expensive, that borrowing. At 14% thereafter. Yeah, you see, it's worth reading the notes, isn't it? and it can make voluntary repayments, which it's actually done post the March 25 year end. That's it. As at March, 134 million shares. There'll be a few more from, I think, another 4 million more shares issued for warrants. So it's not, it's not a vast amount. But look, there's been quite a bit of dilution in the year. You might see further dilution, as I say, in the future. Okay, let's pause. Here we are, we're back at the company presentation. They give some good examples here. And this was all covered in the IMC webinar. It's really good. I mean, it's a very, very good briefing explaining what happened in an individual house, how the Leakbot detected it, and then they sent somebody in to fix it, which again, that's one of my queries actually. How can it, here we are, this is the Leakbot branded van again. I don't see how it could possibly be economically viable for Leakbot to have its own team of plumbers covering such a vast territory as 25 states in the US. That just doesn't make sense to me. So I think we need some clarification on these. Maybe the Leakbot van is kind of a mock-up, or maybe they've just got one or two of those vans or something. Maybe they use outsourced plumbers who are just trained in how the Leakbot thing works, which presumably wouldn't be a big deal because it's just a little 20 quid or whatever electronic box that gets strapped onto the pipe. It doesn't have to involve cutting any pipes, which is a big USP. And then it just has to be logged onto the client's Wi-Fi. So this is why, conflicting information I'm getting from the company about whether they actually install these items using an engineer or whether the customer self-installs, because they kind of said both. Maybe it is both. Maybe some are done remote by the customer and some are done by an engineer. But I'd just like clarification on that, because it's only $60 a month, $60 per annum revenue. So the sensitivities on the cost side, if you're having to send an engineer out to visit the client's house, well, that would blow more than a year's worth of income, wouldn't it? That's my point. Whereas if this is a self-install and forget type of device, then I can see that $60 a year per unit is a modest amount, but could be high margin. So I think there is sensitivities to the unit economics on this, because we're relying on the company's forecast of the unit economics. There is a slide on that somewhere. Let's see if I can find it. And they're very small numbers. So my point being that if it turns out that these things break down, sorry if I'm making you dizzy, scroll, and they have to send engineers out to the client's house, then that would just blow the unit economics out of the water. It just wouldn't work. Right, I'm back. I've remembered where the unit economics slide was. It wasn't in the company's presentation. It was actually on a Dowgate note. So thank you to Dowgate for making this note available on Research Tree. They said the results for March 25 were in line, but they were actually the table below shows that they were slightly worse. A 6.1 million loss, which is a hefty loss against forecast of 5.7 million. So that sort of contradicts itself there, but never mind. I'm looking for here we are, the forecast. So no profit, PBT profit, until March 28 year end. So that's quite a long time to wait, isn't it? So you've got to absorb another year of heavy losses in March 26 here. But the company and the broker are explaining that's because they expense the actual capital outlay for the units up front. So let me find what I'm trying to do. These slides, I recognize them. They're off the company's presentation pack. But I think there's some more. Yeah, that's the same. That was in the other. Here we are. This is the unit economics bit. So this is interesting. So basically, this is the revenue line. It's just $5 a month. So this is small beer. And I think the insurance company pays some of that up front. So that's your revenue, that doesn't seem to show any inflationary increase there in the contracts. Probably might be better to have some inflation increase put in them in case there's another outburst of heightened inflation. But anyway, hardware and shipping costs, $30. Now, what's this average repair cost? I put that as, and then the contribution here is this line here. That's gross profit effectively. So that to me is suggesting average repair cost is saying they've got costs of repairing the Leakbots. Because that wouldn't be a plumbing repair, would it? So I don't really understand that line there, average repair cost. Perhaps somebody could explain it to me. I might give the company a ring and see if I can put these questions to the CEO or the FD if they've got time, but I don't want to take up their time when they need to be running the business. So, okay, hardware and shipping cost is self-explanatory. This device doesn't cost much. This is in dollars, I think. Yeah, dollars per unit. So costs bugger all to make these little units, and that's an upfront cost that Ondo absorbs through the P&L. This average repair cost line, that's what I don't understand. Why would you have a repair cost for the Leakbot units in year one? Do they have to send someone out if the customer doesn't install it right or whatever? So I think that line is key, and why we're having ongoing repair costs in future years. So that needs some explaining. And as I say, the sensitivities of that, if you need to send a plumber out to someone's house and Ondo has to bear the cost of it, that would blow this economic model out of the water. It just wouldn't work on $60 a year income, would it? So that, I think, is quite an important question. And then the gross margin you can see is negative in year one. That's why you've got that 2-year delay until it starts making profits overall. So it's kind of the opposite of the business model I like. You know, I like to see it the other way around, where you hit the ground running, making bumper profits from year one. This is the opposite. You actually incur the costs in year one. So that is a bit of an issue. But there again, if in cash flow terms, the insurance companies are paying it, then that's fine, probably. So how reliable are the unit economics? That is my key question mark over this, because that'll determine whether this is a major multi-bagger or it goes nowhere as a share. So the contracts, I've heard some people say they're just trials. Other people say, no, they're proper contracts. So I think we need to firm up on these contracts. Are they 5-year long-term contracts or are they just trials? That, again, is absolutely key. And the churn as well, because the fact that it didn't really work in the UK or the Nordic does make me a bit uneasy. But it could be, as I think the management imply, that the insurance people have to pay a lot more to insure their homes in the US, which is why this does work in the US. So I get that. So I think, as bulls on the stock have told me, basically ignore everything. It's all about America. If they crack America, obviously it's a vast market, and you could have a major multi-bagger on your hands, couldn't you? But we're not there yet. Management sound pretty confident. Yeah, the fixing of the leaks then, why isn't that just outsourced? I don't really understand why you would have your own team of plumbers, which is what they seem to be saying. What's the track record of management? Have they done other startup type businesses before, and what happened to them? What else? Oh, it said they were March 22 IPO. I had 21. Maybe it listed on Aquis first or something. I don't know. But they claim to be the world leader. It did run through as well. They said, quote, we invented this technology and we send them through the post and it's self-install. That was a quote from the management now. So it does sound interesting, doesn't it? Oh, and the Leakbots report the possible leaks to the insurance companies as well. There's a sort of online alert service. And I think it alerts Ondo as well. So it'd be interesting to learn more about what that process is and who does what when a leak is detected. How many false leaks are reported? That's a key question that's just occurred to me as well. What that would absolutely kill the business model if it's coming up with lots of false. They're focused on the USA and getting to cash flow break even. They said, we visited 4,000 homes and fixed 7,000 leaks. That sounds pretty impressive. What else? Yeah, here we are, April 25, it repaid 1.4 million of the loan notes, the vendor loan notes, I think. And you've got May 26, the last tranche of warrants, which is only 0.8 million quid at 20 pence. So the warrants are, and he was emphatic they won't issue any more warrants when asked in an IMC Q&A. Actually, I've also got to say, in the Q&A section on IMC, I really liked the way the CEO just sort of, in a slightly humorous but exasperated tone, he said, we've, quote, epically failed to answer all these questions. I thought that was quite funny. So he acknowledged, no, they hadn't answered all the questions. But he said, let's just do quick fire. We need to get through as many of these as we can. So I like that. I thought that was good. Bit of humour, bit of self-deprecation. I think he's obviously a strong entrepreneur, this Craig Foster. Well, that's how he comes across anyway. I'll have to check out. Somebody suggested I have a look at his LinkedIn profile, which I'll do because I like to know who I'm investing in. Yeah, I think those are the main points actually. And competition, they mentioned the competitors, but I think it's best to do your own research on competition rather than just listening to a company telling you who the competition are, because they're obviously motivated to downplay competition, aren't they? Naturally. So yeah, independent third party information is always much more valuable than just listening to a company itself. So it's a good slick presentation. I think the CEO is focused and passionate. He concluded by saying we've got an opportunity to be the industry standard solution to a $20 billion US market opportunity. Well, no wonder people are getting excited. If you hear that from a company, you think, oh, it's going to go to the moon, it's got 100 bag, I've got to buy some. Execution, though, is always a lot harder than the idea. He also said something interesting about one of their insurance clients called Nationwide, saying they've extended it, so it's a trial, they've extended it to 25 states now. Well, that's encouraging. I think if trials are extended, that's a good signal. And he said that they believe in this product. He said, quote, they fundamentally believe this is where the insurance market is going. Now, that's him talking about one of their clients, speaking for the client, really, which we can't verify unless somebody picks up the phone to Nationwide and asks them about Ondo, which would be a good idea, actually, to get some third-party evidence about this. But yeah, overall, I think it looks interesting. So I'm going to do a bit more work. I've tried to give a balanced view of all the various issues there. I hope that I might publish this, actually. It was only meant to be a test of me trying out Loom to see if I could switch from one tab to another. But I think it's actually worked out okay. So I might publish this.